Welcome to the deep dive. Okay, so if you're involved in any serious financial planning in the UK, you really have to get your head around the basics of income tax structure for individuals.
Absolutely. It underpins, well, pretty much everything. Investment location, pension strategy, even just understanding what happens when your income changes.
So it's more than just knowing the tax rates.
Oh, much more. Today we're focusing on, let's call it the fixed allocation mechanism. Basically, the strict order HMRC uses to tax different income types. Understanding this is crucial for tax efficiency and just giving sound advice.
Right. Okay, so let's start building that picture. The foundation is the personal allowance, isn't it? That chunk of income you don't pay tax on.
Exactly, the PA. For most people, it's a tax-free shield, but,
Right.
and this is a big but, it's not universal.
Ah, you mean the phasing out for higher earners.
Precisely. Once your income goes over £100,000, that allowance starts to shrink, and it disappears completely by £125,140.
Which creates that really nasty effective tax rate spike in that band.
It does. It can be close to 60%. And that's where planning comes in, particularly with pensions. Making a pension contribution reduces what HMRC calls your adjusted net income.
So you can potentially bring your income back down below £100,000 and get that personal allowance back.
That's the key planning point. It's often the single most valuable tax break for people in that income bracket, a very powerful tool.
Okay, so once we're past the personal allowance, whether you get it all, some of it, or none income starts filling up the tax bands.
Correct. You've got the basic rate, then the higher rate, and finally the additional rate band, each with its own percentage.
But it's not just a free-for-all, filling those bands with whatever income you like.
No, absolutely not. This is where the mandatory order comes in. Think of the tax bands like buckets you have to fill in a very specific sequence. HMRC dictates the order.
Okay, so what's the sequence?
Right. There are three main categories of income, and they must be stacked in this order. First, always first, is non-savings income.
That's things like salary, self-employment profits, rental income, most pension income too.
Yes, exactly. That non-savings income goes in first and fills up the PA and the lower bands. Only then do we look at the next category.
Which is?
Savings income. So bank interest, interest from bonds, that kind of thing.
Okay, non-savings first, then savings.
And finally, the third category is dividend income from shares.
So non-savings, then savings, then dividends. Always in that order.
Always. And this order is critical because it determines how and when other specific allowances get used, or sometimes whether they get used at all.
Can you give an example? Like, how does this impact someone with, say, salary, some savings interest, and some dividends?
Okay, let's take the personal savings allowance, the PSA. This gives basic rate taxpayers £1,000 of tax-free savings interest, and higher rate taxpayers £500.
Right.
But if you're an additional rate taxpayer earning over £125,140.
Let me guess. Your non-savings income has already filled up all the basic and higher rate bands.
Exactly. So your savings income starts right away in the additional rate band, and additional rate taxpayers get zero personal savings allowance. It's completely wiped out by the fact their non-savings income was taxed first.
Okay, that makes sense. So the mandatory order directly impacts the value of that specific allowance. What about dividends? You mentioned a dividend allowance too.
Yes, there's a separate dividend allowance, currently £500. Now, interestingly, this allowance applies regardless of your tax band. Everyone gets it.
Ah, so it's different from the PSA in that way.
It is, but crucially, because dividends are the last income category to be taxed, you've already used up your personal allowance and filled your lower tax bands with your non-savings, and potentially your savings income first.
Meaning the dividends often end up being taxed at your highest marginal rate, even with the allowance applied to the first bit.
Precisely. The £500 allowance just takes the top slice off. The rest is taxed at whatever rate applies at that point in the income stack. This mandatory order, non-savings, savings, dividends, dictates the real-world tax impact.
So understanding the structure, the PA phasing, the bands, and crucially this fixed order of income. It's not just academic, it's fundamental for any kind of sensible financial advice.
You couldn't put it better. It's the absolute bedrock for making compliant, suitable, and tax-efficient recommendations. You have to know the rules of the game.
Okay, let's leave our listeners with something to think about then. We've established non-savings income comes first, and that includes most pension withdrawals. We also know pension contributions can sometimes restore a lost personal allowance. So how might you strategically use this mandatory ordering, perhaps when structuring withdrawals in early retirement? Could drawing down pension income, treated as non-savings income, be cleverly managed alongside other income streams to say, deliberately stay below that 100-pound K threshold and preserve the full personal allowance.
Yeah.
Something to mull over.